Today I'm on Vanguard.com and I'm demoing various target retirement funds. So what's a target retirement fund? The idea is, or the concept is pretty simple. You pick a fund with your target retirement date. Let's scroll up here and I'll show you what I mean. My target retirement date, let's say, is 2060. So I picked this Vanguard Target Retirement 2060 fund with a ticker symbol right here, VTTSX. And I put all my money into it, for example, making this up, and I let it sit. And over time, the nice thing about target retirement funds is that it's going to adjust your asset allocation so that it's appropriate for your age and your risk tolerance and your specified target retirement date. So let's take a look at what that actually means. When we scroll down here, the first thing that we notice is that our target 2060 fund is heavily weighted in stocks. In fact, 89.6%, nearly 90% of our holdings are in stocks, 10% are in bonds. And the reason is because stocks are generally considered riskier investments than bonds, but at the same time, and they're riskier because they can fluctuate greatly in the short term, but at the same time, stocks also tend to outperform bonds or cash equivalents in the long term. So given that we have a target retirement of 2060, we have about 45 years, ideally, until we need to take that money or to spend that money that we have in this fund. So what that means is that our portfolio allocation initially is going to be higher risk, higher reward, because there is considerable time left, about 45 years, for the investor to ride out any potential bear markets before he or she needs the money. Let's take a look on the flip side, or as a point of comparison, to a Target 2015 fund. So I'm going to scroll up here and show you. This is a Target 2015 fund. Oops, scrolled up a little too far. Vanguard 2015 fund with the ticker symbol VTXVX. The first thing you're going to notice, and I'm going to scroll down a little bit, is that our asset allocation is dramatically different. So going back, this is our asset allocation of a 2060 fund. This is our asset allocation of a 2015 fund. The first thing you notice is that our allocation of stocks has dropped from roughly 90% of our portfolio to only about 50% of our portfolio. Why is this the case? The reason is because bonds are considered less risky investments in that they're less likely to dramatically fluctuate in value should the market change. So people who are closer to retirement, meaning closer to needing to utilize their state savings and withdraw their savings, tend to prefer a higher weight of bonds in their portfolio because it's a safer investment. The trade-off between a safer investment, meaning, again, higher allocation of bonds, and a riskier, I shouldn't say safer investment, I should say safer portfolio, meaning a higher allocation of bonds, and a riskier portfolio, meaning a higher allocation of stocks, is the potential rate of return. Stocks, like we mentioned previously, tend to yield higher rates of return and thus outperform bonds. And so that is the opportunity cost of holding more bonds in your portfolio. And I'm going to show you exactly what I mean by pulling up this chart, also on Vanguard. And this shows the mixture of, or the returns of bonds versus stocks from 1926 to 2013. So what you see here on the far left is that bonds have a much smaller deviation. So their worst year from 1926 to 2013 was a drop in value of about 8%. Their best year was about an increase in value of 32%, and year over year, about on average, they returned 5.5%. What you see on the far end of the spectrum, the far right end of the spectrum, is that should you have held all of your assets in stocks, there's a much greater deviation, but also a much greater yield. So what we're seeing here is that stocks tend to yield about 10.2%, which is nearly double that of bonds, but they also can fluctuate dramatically. Their best year would have yielded you or a rate of return of about 54%, but in your worst year, you could have lost nearly 40% or nearly 43.1% to be exact, of your value. And that is something that people, as they get closer to retirement, don't want. They don't want these high fluctuations, so they're willing to give up that rate of return in order to have more a steadier, safer investment portfolio.